This is the De-equitisation of Global Markets panel, although I think we're going to focus quite a bit on the UK as well. But these guys are going to give you some insight onto what's happening and hopefully why and where we go from here. So expertly moderated by David Belle here. I'll hand straight over to you. Could we give them a welcome, please?
Hi everyone. I think this is a really interesting panel because we've heard so much over the last few months of how poorly the LSE is doing, UK listed equities. But firstly, I want to hand over to everyone just to introduce themselves briefly. Sarah, should we start with you?
Yeah, sure. Thanks, David. I've spent most of my career as a multi-asset portfolio manager. And at the moment, I see huge potential in terms of the development of hyper-personalised portfolios and how we blend multi-asset building blocks. I'm really excited in terms of the structural that's happening in the industry. So yeah, delighted to be here.
Lovely. And yourself, Joe?
Yeah, good afternoon, everyone. Hi, I'm Joe Winkley from Winterflood. In terms of kind of how we fit into things, I think certainly the listed equity markets are absolutely core to what we do. For those of you who haven't come across Winterflood, we're one of the largest liquidity providers in listed markets, all the way through from AIM stocks to FTSE 100 stocks. And also, in particular, we are distributor of equities into the retail market. So some of you may have come across us in terms of fundraisings we've done via our wrap platform, which goes straight into retail platforms like Hargreaves Lansdown, AJ Bell, and Interactive Investor.
Perfect. And yourself, Mark?
Yeah, Mark Warrior. Like many people in the room, I'm a private investor, but for 30 years I was a UK equity fund manager. I worked at Mercury, BlackRock, Troy, and Majidi. And I now sit on a couple of investment committees, including an investment trust called Onward Opportunities, which invests in UK microcap. And I recently launched a podcast called The Business Case. I've done 12 so far, where I've interviewed UK chief executives, which got to give that a plug.
And finally, yourself, Cathal.
Thanks, David. I'm like Mark and like yourselves, quite predominantly a small cap investor. Anyway, with spare cash I put them into. But along the way, previously for 15 years, I was a corporate finance sell-side primarily person. And the last 10 years, I've done 5 IPOs. We have a small team in Dublin. There's 3 or 4 of us. We usually put a venture together, find distressed assets, put them on AIM. So we've done 5 AIM IPOs. I usually go in and become the largest shareholder, take the role of executive chairman, and roll up our sleeves and try and get a success. We've had 2 probably pretty good successes. One was Amrit Pharma. We IPO'd it at 50 million in LSE, and ultimately went to NASDAQ and was sold for $1.5 billion. And then my more recent one was hVivo, myself and my co-founder there, Carl Dalton. In the audience, we IPO'd it at sub 10 million, and we got it up peak pandemic, 400 odd million. And then we exited last year when it was around close to 200 million. And now my 2 current projects is Poolbeg Pharma. I think the speakers earlier said we have a very, very small cap on London. It's got a novel cancer therapy. And we also have a second vehicle, European Green Transition, also on AIM.
Perfect, thank you for that. So just to kick off, first question. Tell me, what is going on currently? Because we're hearing so much news about how poorly the UK is doing. Earlier, we saw that there was a discount of about 35% on UK equities to US equities. Why are we in this state? Who wants to kick off?
Shall I go first?
Yeah.
So I think the first thing to say is the panel is de-equitisation of global markets. This is not necessarily a UK-specific problem. We have seen reductions in listings in the US, we've seen reductions in listings in Europe. But I think it's also worth saying that we have been worst hit. So we have gone from somewhere around, I think it was 10 years ago, 2,400 listed companies in the UK down to 1,700. In particular, if you look at the kind of smaller end of the market, AIM has gone from 1,700 companies at its peak to less than 700 now. So we're being hit harder than anywhere else. And I think that comes to the question, which is, why is it going wrong here? I think there are a number of factors in play, and I would look at it as a little bit of a kind of vicious circle, which is that the UK as a listing venue and as a country has been under the cosh a bit, probably post-Brexit. That leads to less liquidity. We were hearing earlier from Stephen Yu about the liquidity premium you get in the US. You've got less liquidity. You've got less focus on UK stocks. That means you do have that undervaluation. You've got that 30 to 40% undervaluation relative to the US. There's also an undervaluation relative to Europe. And what does that mean? That means that companies will jump ship. They will change their listings where they can, and we've seen that. But also importantly, you will also see delistings and companies taken out. So last year, there were about 50 companies that were taken out because they are cheap. And so on the one hand, you've got this very attractive valuation in terms of the UK market, but it is not really stimulating any buyers out there. Companies are delisting, they're moving, and this is, I think, the vicious circle that we've got to try and break.
Sure. Anyone want to add to that?
Yeah, I would agree with that. But I think the UK has had a kind of specific issue in that, it's a long story, but after the Second World War, UK companies financed corporate pension schemes through defined benefit schemes, whereas in Europe it was mainly a pay-as-you-go scheme. And really 30 years ago, the decision was taken by the government to de-risk those schemes by divesting from UK equities, particularly into bonds and LDI instruments, etc. So you hear a lot of press at the moment about the problems in the UK equity market, and Charles Hall, who's been kind of leading the charge, you're going to hear from next about some of the solutions. But this problem really is 30 years old. And really the first 10 years of this decade where you saw the big moves in DB schemes out of UK equities into other assets. Now, the good news is that it's happened. There haven't been any forced buyers of UK equities for really kind of 20 years. So as Lara said earlier, the valuations are very depressed in the UK, and UK companies are under enormous pressure now to try and create value. Which is why when I switch on my computer at 7 o'clock in the morning and look at all of the regulatory news service releases, you have to wade through 30 or 40 announcements of share buybacks because companies have realized, well, if we can't find people to buy our shares, we're just going to buy them back ourselves. So that's very enhancing if you're an existing shareholder, and probably means that our market, because there aren't any forced sellers, is going to be a bit more resilient. If we go through choppier territory in terms of equity markets more generally.
Perfect. Cathal, do you have anything to add?
Yeah, David, I have a slightly different view. I think the markets all around the world for the last, it's only 4 years ago the UK market had the best two markets in its entire history. Good old COVID, 2021, the UK market was going through the roof, as were most of the markets in the world. So I think people have a short-term memory. Like 4 years ago, we weren't having this discussion. Mm-hmm. We were kind of wondering how high could it go. Mm-hmm. Yeah. There's been a crap 3 years now for investors. But bear in mind, every market in the world, like NASDAQ had the worst year ever for 2 years running for IPOs. We all think money's going to NASDAQ. Australia had the worst year in 15 years for IPO consistently for the last 2 years. So yeah, it has problems here. But I actually think it's because you've been through a period of free money. George Bush brought interest rates near zero after 9/11. That allowed people to not having to list. You had a whole series of things. Mark is right about the pension funds. Pension funds have dropped off. But I think looking forward, I'd be very optimistic. I think we've been through probably the worst 2 or 3 years. The big one, I personally been buying shares. First shares I bought was November 1981 as a 16-year-old. Been buying shares every time I've spare cash. Except, and hands up and being honest, the last 2 or 3 years, and my colleague here knows, I'm always dabbling everything with Carl Dalton, everything with spare cash, we throw it, but the last 2 years I got very careful. And guess where we put the money the last 2 or 3 years? Magnificent Seven, just EFTs in the States. So much of that money went to EFTs because the damn things are going up 30 or 40% every year. Amazon, Facebook, that has changed. I won't put another penny into those EFTs because Trump has made it clear, and I think we all should thank you, Mr. Trump, they used to say, is that he has made it clear investing in North America is dangerous, and he's going to mess with the dollar. It's down 10, 12%. It's never had as big a change with sterling. So I think that huge flow of money to the Magnificent Seven, and I was one of them up at any spare cash, is over. And you can see them, they're all tailing off. So I think for the London market, yeah, it's got a lot of other issues. We are in the era of deregulation. So I think we'll come to cure in a minute, but I think there's still a lot of regulations. But I actually think in 12 months' time, we could all be sitting here and say, oh, the market has slowly got much better, much more interesting, and flows are back. But I think it's that free money, interest rates were so cheap, people didn't need to do IPOs. Magnificent Seven hoovered the money in the last 3 or 4 years.
Definite misallocation of capital there. Sarah, just you finally on that point.
Yeah, sure. So I think it's important to reflect what's going well in the UK. So we remain a fertile ground for innovation. We are home to the fastest growing companies in Europe. We're fourth in terms of the number of unicorns. And I would also say that the challenge isn't just on the investor side. Growth has been subdued for a while. Companies themselves aren't raising any fresh capital. So when the governments are looking at policies such as encouraging pension funds, especially on the supply side, to invest more capital in terms of private capital markets, it's important that public and private markets work together so that companies of all sizes can raise money and scale. I would also say probably passive investing has had an impact, maybe more of an impact in terms of UK smaller companies, in terms of how it's changed that segment. And quite a lot of funds now that track the FTSE UK smaller companies. I mean, quite a lot of that index now is 50% is in investment trusts, and the rest is in operating companies. So they're tending to allocate more to other funds and not necessarily to UK companies. And it's what you said in terms of creating that feedback loop, in terms of that is, narrowing the investor base, reducing liquidity, and making large funds less interested in sort of allocated to the UK. And I think, in terms of the MSCI World weighting, we're 4%. So we need to try and somehow improve that visibility if we can.
Yeah, as you say, it's only 4% allocation, so it does look like there's the potential for much bigger allocation.
Absolutely, yeah.
I think an important thing that you raised there was the policy side.
Yes.
I think, to what extent currently do you think the actual government's policy is having investors, funds, asset managers, real money actually kind of scared away from the UK a little bit?
Sure. So what I would say is there's, positive changes in terms of regulations from the Hill Review, from merging the premium and standard segment. That reduces a layer of complexity. It makes us, the UK, more in line with international norms, so that's very positive. There's changing regarding, rules concerning the prospectus. At the moment, companies have to leave a 6-day window in terms of the open offer. That's going to reduce to 3 days. And companies are sometimes unnerved by having such a long window, especially if it straddles a weekend. Something happens in markets and that confidence drops. But what I would say, I think we need to be realistic in terms of how far regulations is going to reverse the number of listings. Because if we think back to recent companies that have gone to, say, the US, they've cited commercial reasons, mostly their operations being based in the US, or tax incentives. So I think, looking at regulation can solve part of the problem, but it's not the whole puzzle.
I think, as you say, the AstraZeneca CEO was looking at New York, but
yes,
I think it's because he's seeing the compensation that US pharma companies can get from, their shareholdings, and saying, I want a piece of that. Joe, you mentioned earlier that this isn't necessarily a UK specific issue. However, there are some dislocations with the UK. Could you expand on that a little bit more?
Yeah, I think it kind of comes back to this point, and just picking up on the regulatory piece, that we have seen a fall off in listings globally. And were we having this conversation in 2001, as you say, Carl, we'd be in a situation where we had 120 IPOs in the UK. No one was talking about the regulatory framework at that point. But what we have seen is the IPO markets they've been limited globally. We've seen delistings, we've seen companies staying private for longer. These are consistent themes everywhere you look. But I think that my point there is that we have been disproportionately impacted in the UK. We are not seeing that many companies moving, if any, moving from the US to the UK for valuation reasons. We're seeing a lot of people considering it now. And it feels that there's more of a kind of global market dynamic at play that may not have been the case 5 years ago, where you can slightly pick and choose where you list, depending on what kind of pool of liquidity you want to get access to, and importantly, what kind of valuation you want to get as well. And I think that's been particularly driven by the tech stocks, because in the US, we are seeing very high valuations for tech stocks. We are less of a tech market, and I think that is really driving some of the patterns that we're seeing in terms of where companies are choosing to list, and in particular, where companies are choosing to move.
Yeah, makes a lot of sense. Gents, do you have anything to add to that point?
I think, look, I go back to the thing is that I'm a typical entrepreneur. We've developed 5 companies, and we raised money recently for one of our companies, Poolbag, and it was the first time in 3 years we were oversubscribed substantially. We only wanted to raise 3 or 4 million. We had offers of 7, 8 million. That was a classic example of my belief is, hey, the market is coming back. And I always think as well, like UK, Irish, have an Irish passport, an English passport, but we're all Europeans. We should be quite proud. America is a very different market. I firsthand, we IPO'd Amrit, had it in London. Guess what? We moved to the NASDAQ and the share price halved. Not for 18 months, for 8 months, 18 months. Yeah, ultimately NASDAQ was a success, but oh boy, it's expensive. We announced to the market earlier this year we're going to put Poolbag in NASDAQ. Share price collapsed. And eventually we engineered a graceful exit from going to NASDAQ. We raised the money in London and we're very happy here in London. So I think my belief is that, yeah, look, nobody wants to mention the big bad B word. As an Irish person, I can mention the Brexit word. Like when we're living here as British, and I'm both British, and my kids all have British passports living in Dublin, but I think we need to shake ourselves up and be more optimistic. Hey, it's over. That kind of war of in, out, it's done. It's done. I think Europe's going to be a great place. Trump needs a Nobel Peace Prize for bringing the Europeans together, for telling the Europeans, do not depend on those, no offense to the Americans here, don't depend on those nasty Americans, because history repeats itself. America did not want to enter the First World War or the Second One until, guess what? The Japanese brought them in, and then Hitler declared war. That was the 30s, they had huge tariffs. History's repeating this. We're in the 30s now. But guess what? I think Europe, the UK, have a fantastic future ahead of itself. There will be peace in Ukraine sometime in the next 6, 12, 18 months. Who's going to rebuild Ukraine? It's going to be Britain and the rest of Europe. It's been done before they rebuilt Europe. So I actually think, and it's a lot of it's optimism. I just think the big bad word that divided this country is over. The big B word. A lot of people think, blame this, blame that. But equity markets, the whole world, like the Irish stock market, nobody talks about, is goosed, it's closed, it's one was hung up to, like it's gone. And that was because the government massively over-regulated. The government did its best to kill it. And now suddenly, oh, how do we kill the Irish stock market? And that's what Simon French said. If the British government doesn't do something, the future of the London Stock Exchange is the Irish one. It's as good as closed. But I don't think it's that. I still think I'm very optimistic. I'm 60. Carl, how many more IPOs have ahead of us? At least 5 or 6 of them, have we, over the next 10 years? So the only market I'm interested in doing IPOs as an entrepreneur is the London market. It's easy. The brokers are here. Yeah, it's been a bad 2 or 3 years, but I keep saying 2005, magic year. 2020 and 21, it was the best years ever. And that's only 3.5 years ago. Well,
you're absolutely right. It's, despite all the kind of gloom, it is still the biggest pool of capital within Europe. And if you're going to do an IPO, London is the place. And there's actually a big opportunity for London at the moment because within the private equity world, they've got a real problem with realizations. You know, they haven't been able to sell assets. So you have this kind of growing inventory of companies that needs to find some sort of exit. So London is an obvious place for that. But it does require, I think, PE to have a more kind of creative approach to listing companies. You know, it's really important if somebody goes for an IPO that they make money, right? Yeah. You know, appetite dries up pretty quickly if people lose money. And unfortunately, a lot of those 2021 IPOs, you know, the investment bank that won the pitch was the one that promised the highest price for the largest number of shares. So there's an appalling aftermarket. You know, we've got to kind of relearn successful IPOs. It's about a small initial free float, people make money, and then there are follow-on issues, and you get this kind of virtuous cycle rather than the vicious one that we had after 2021.
Yeah, I think there's an interesting shift in the conversation there, more over to private markets. I think after Mansion House, Rachel Reeves had announced this Pisces scheme, which sounded to me like she didn't really want to fix the listed markets necessarily, but she was focusing more on the private markets. Now, when I first looked at Pisces, it looked like it was something that was rampant for potential fraud. What are your thoughts on the government not necessarily looking at listed markets, but really focusing more on private in the context of, private equity takeovers from US firms in the UK, etc.? Anyone want to start?
I can give you my thoughts on that. I think Pisces is a really interesting development, because I think there are two different ways of looking at it. And I think the first one is the one that you're kind of outlining, which is, it's not quite a capitulation, but it's an acceptance that the listed markets aren't flourishing at this moment in time, a lot of private companies, and is there a way of unlocking liquidity in those companies, allowing people to create more of a secondary market around it? And that would be the kind of positive spin. And the way that the LSE is looking at this is they're kind of saying, look, this is almost like kind of the gateway into the listed market. You get a bit of periodic liquidity, and the next thing you know, you're going to start wanting more of that, and you're going to want to list. I'm not sure where you land on that, because I think on the one hand, you could say what you're doing is encouraging private companies to remain private. You're giving them the best of both worlds. They're getting liquidity, but they're not having to have the disclosure and the scrutiny that the public markets give. But if it does work as a kind of halfway house and a stepping stone into being fully listed, maybe that will work. I think I would say the jury is open on that one, but I'm not sure it is a vote of confidence in the listed markets. That's the way I would see it.
That's pretty much how I saw it as well. Anyone want to add to that?
I think, look, Rachel Reeves has a big problem. Like, we all keep looking at America.
Just the one.
Yeah, well, no, we'll hear on the stock markets. And here's my view. Her problem is she knows the stats in America. I think it's almost 60% of American shares are held by pension funds. London used to be, 38 many years ago? Now it's 6. But that's a misnomer somewhat. The vast majority of those mentioned American pension funds are 407ks, of which your average taxi driver has, every shoe shine boy, everything in America. So I actually think what Rachel Reeves should be doing, she was looking at how do you get that 4% to 20 or 30% in UK equities, both private and public. And then she's getting smacked off by the pensioners. No offense to pensioners. Hey, don't mess with our pension. We don't want to put into crappy shares. We're happy in property or high interest rates. What you should do, the Irish government did it about 15 years ago, had a similar problem. Leave the ISAs alone, leave everything alone, but introduce a UK-specific 407k. It means an ISA equivalent. But you must, the only condition, you must invest in UK, have 2 of them. One for UK public equity. And so suddenly you're not messing with existing SSI or ISAs and SIPs. You just create a 407k and say, right, everybody, big and small, you get a tax break if you invest in UK listed shares. Then something like that. An Irish government created this huge, like 20 billion in this called SSI, special saving accounts, because they were trying to take money out of the system. But instead, so I think it can be fixed really quickly. But I think the big one, let's forget about NASDAQ. It's a big, bad, different market. UK should compare itself to the other exchanges in the world. America's got so big. I think if you think about 205 to 210, 215, London was rivaling New York. But like the Americans, they've got away. They've moved ahead. So I think London, compare yourself to your peers. We're Europeans and Australians. So I actually think it's not that hard to fix. Something like that means everybody in the room can then, there's an incentive to invest. Why should I in my ISA? I have an ISA and a Facebook shares, I have NVIDIA shares, and get a tax break. But when bloody Uncle Sam's shares, that's criminal. I shouldn't get a tax break to invest in American shares. Your tax breaks, as the 407, should be for UK listed equities, and then do the private companies after.
As you say, there's a tax break on US shares, but you have to pay stamp duty on UK.
Yeah, exactly. There's this.
How does that work?
But I think, Rachel, I don't want to beat up the current government. Look, we all give, she has to tread carefully. If she messes with ISAs or SIPs, they say, hang on, why not just start a whole new one? It's called the equivalent of 407, and then this is for UK listed, and suddenly you'll have huge liquidity. Doesn't take much to change it.
Absolutely. Sarah, have you got any?
Yeah, just to pick on Cathal's point, we always look to the US as a kind of benchmark in terms of competitiveness. But, if you look at a country such as Sweden, where, the number of IPOs there has flourished. And mainly the sort of factors driving the success of those transactions has again come down to, cornerstone domestic investors in terms of pension funds. It's come down to, a domestic buyer in terms of Swedish households. It's come down to a long-term creation of an equity culture from launching, a national savings scheme back in the 1980s, which means Swedes are now, leaders in terms of fund saving. And then just also touching about, policy, I think, one of the reasons pension funds started to sort of retract from allocating to the UK was in, I think, the 1970s. There was a slight change in a tax break where if they held, say, UK shares, they'd get a tax break in terms of, in terms of what they completed. So that's where, again, when we're changing policy, we need to make sure that we're diagnosing correctly and that the measures we've put in place are going to have the intended positive impacts that we imagine.
Yeah. I think you touched on a really good point there, which was culture. You mentioned,
yes,
there's domestic savings going into certain places. Now, something that Duncan Lamont has said from Schroders, I think he's been on a few presentations today because his charts are so good, was that since 2013, between 2013 to 2023, Brits have lost effectively £500 billion by not being invested because they've been invested in cash ISAs.
Yep.
Now, there's so much capital there to be unlocked, but what responsibility is it on the individual to actually go and unlock that capital and actually shift themselves up the risk curve? Is it down to IFAs? Is it down to the government? Is it down to the broker? Who where does the responsibility lie to basically get that money moving out of cash and cash deposits into the market? Because there's a lot there.
Yeah, I mean, I think it's at 300 billion, is it, in ISA cash savings. So I think what's good to see is that there is buy-in from the government, from advisors, from, broader market participants that we need to do better. And I think one of the initiatives that are being discussed is sort of a research platform where retail investors can access, so research is more accessible to them. Now, in terms of who covers the cost of that,
taxpayer.
Yeah, or
ironically.
Or is there a sort of acknowledgement from companies that, if they want to increase visibility, then they might have to give a little to get a lot back. But yeah, it's definitely room for further consultation, I think.
And from your perspective, Joe, when it comes to, from a broking aspect and retail flow and retail distribution, obviously, is your key thing. What are you seeing there?
Depends where you look in the market. So just to kind of break it down, if you look at something like FTSE 100, retail is not a huge part of that. It probably is in value terms, but in percentage terms, it's less than 10%, so probably about 7% in retail. The further down the cap spectrum you go, the more important retail becomes. And I think this is the key thing. So when you look at the AIM market is circa 30% owned by retail. And that's really important because it not only actually drives the market. If you're trying to do an IPO, as you were talking about, a small IPO, you are really going to need that retail investor base. But also in terms of secondary market liquidity, and also importantly in terms of inflow. So again, I was looking at the numbers in terms of our kind of retail intelligence around trading that we get to see. And round about sort of 25% of all trading in kind of small cap stocks is done by retail investors. But more importantly, if you look at the AIM market, and we're kind of talking a lot of negativity, but actually we saw 160 million, or we have seen 160 million of net retail inflows into AIM companies over the course of this year so far. Last year it was about 270 million. So to the extent that we're seeing kind of institutions and small cap funds, as you were mentioning before, kind of pulling out of the market, where's the slack going? The slack is being taken up by those retail investors. And I think this is the challenge that we have, which is that, you made some really good points, that we've got very low equity participation. It's less than 10% in the UK. In the US, it's over 30%. In Sweden, it's higher. In a number of countries, it's higher. How do we change that? But I think kind of coming back to that backdrop, retail is absolutely critical at the smaller end of the market, absolutely critical. It drives liquidity, it drives fundraising. Where we are seeing it in terms of equity fundraising, there has been huge amount of retail appetite for fundraisings for AIM stocks. We've done some Aquis stocks. I mean, we're talking about small companies, but within that, the retail participation is quite a high proportion of the whole.
Absolutely.
Yeah, I think that's absolutely right. It's really surprised me, sort of spending my career on the institutional side and becoming a private investor again, just how vibrant the retail private investor market is. In some cases, quite meaningful amounts of money that people are investing in small cap and AIM shares. So I think a continuation of some of the trends we've seen over the last few years. Listed companies have to understand that and make sure that they're communicating and giving access to retail investors through the various platform Investor Meet Company. You have people like Research Tree who are doing a great job in trying to democratize broker research. And I think all of the brokers should really submit their research for those retail investors. And you've got Retail Book, which is you've got quite exciting plans to try and make it easier and remove some of the frictional barriers for retail investors to invest in those smaller companies.
And yourself, Cathal?
Yeah, I've gone back into we're all retail investors, everybody here in the room and ourselves in the panel. So I think what incentive, I just think to go back to 2021, peak pandemic, there was a wall of money. Everybody was home at spare cash. So I think, and Sarah says, there's 300 odd billion sitting in cash deposits. You have to have a pull effect incentive. So that's where I think the government does need to have a blank sheet of paper, leave the ISAs, leave the SIPs alone. And America is this monster economy because everybody invests in equity. And it's the one product over a long term we all make money. So I think the government really should. I think the window is there. They could have blamed the EU before it's not there. Use some of those benefits of Brexit. I still think there should be a UK 407k equivalent brought out. But it's particularly for public companies only, because I think the government needs to wake up as well. All governments is that if you don't do IPOs, if companies don't grow, the biggest companies in the world, the big bad, if you think of the Magnificent Seven, the Facebooks, the Googles, the whole lot of those things, right down, all around the world are public companies. Private equity companies never grow. And the reason is they change hands every 3-4 years as you usually go abroad. So you can't build national champions on debt. You can't build them in private equity. You build national champions. Think of the biggest companies in the country, the best names, British Airways, Rolls-Royce, name any of them, they're all public. So the public becomes long, public becomes stronger, and public stays around forever. You don't get taken over. So I think the government, I actually genuinely think Rachel Reeves will wake up sometime and say, do something radical, don't tinker. And 300 billion, you imagine what would happen, Winterfloods, and like just bring in 3 billion extra liquidity, which is only 1% of those deposit accounts. And I think if there was some radical thing as like that old SSIA account had in Ireland, it got a wall of money and it's something around, they get a tax break, they must leave it in for 5 years. It's quite like a nice, but it's UK only. No German stocks, no Irish stocks, no American stocks, tax break for British companies, and you put them in. And you can move the dial on AIM so easy. And if AIM starts moving, my belief is the main market will sort itself out. The main market, the IPOs, weren't happening because PE were sitting doing secondaries. Money was so cheap. There was unlimited debt in the world. The PE funds all around the world are stuck. They're going to have to start doing IPOs. The one thing we talked about, overpriced IPOs in 2021, being honest, that was people. It wasn't really that much private equity. They just did secondaries. It was small companies that were kind of overhyped. Yeah. So I actually think you'll see the main market slowly coming back to life. And the government needs to absolutely drive life into AIM. Get some of that 300 billion. 1% is 3 billion. It would utterly transform AIM. But it's tax-led. Special incentives for British shares, for British shareholders.
I think you mentioned something pretty interesting there. I think we'll try and end this on a green shoot. Rolls-Royce. So the last 5 years, they've done, 1,000%?
Yeah, look at that.
So what's the kind of lesson to take there maybe from UK companies or where the government should be looking? I mean, the reason Rolls-Royce has done that is naturally, the SMR development with nuclear, the resurgence again of airline travel, but also just being a really, really strong business that has had a massive turnaround. But I think that key bit is the innovation. Is that something that's lacking from the FTSE? And is that possibly one of the biggest things that the government could focus on, or at least guide businesses in a specific way?
Well, as Sarah said earlier, Britain, and you should be proud to be British, it's a world centre of innovation. Like if you think about all some of the biggest companies, so I actually think don't worry about innovation in the FTSE. Fix aim first, and the big market will take care of itself. And I think that is coming true. And I go back to Trump. Trump has made it really clear, leave the Americans over there. They're almost like a different world now. And the Europeans woke up, let's just look after the Europeans. Let's build British companies. Let's build European companies. And the test well was as soon as, when, not if, there's peace in Ukraine, that'll utterly transform the whole of Europe. And the two countries who are going to rebuild Ukraine, the ones with experience, is British companies and German companies, because they rebuilt Europe the last time. So that's where I'm optimistic. I think as soon as that peace deal is done, is our friend doing it on Friday, or is it going to wait a year? It will come. All wars end in negotiations, and then you've a country to be rebuilt. And bear in mind, it's a country it's as big as France. Imagine rebuilding France. A lot of roads to build, a lot of data centres to build.
And I think maybe just take an insight just from someone else, if you've got one, just on that last point.
I mean, I would echo all of that. I mean, I think it's important. You're focused on the FTSE 100. I look at it in a very, very similar light, which is what you've got to do is start at the small end of the market. FTSE 100 companies do not necessarily just come in as FTSE 100. Looking at sort of, half of the large caps in the UK were at some point in their life small caps. And I think that is really the lifeblood. I think where we have the innovation, where we have the edge, we need to be turning those into smaller listed companies. Mm-hmm. It does need retail support at that level, and I think that's really important. And I think some of the points you were making there are absolutely key in that. But I think if we can get that market moving, if we can see that as a path to growth into the bigger companies, that's really where the future starts getting exciting.
Perfect. Sam, do we have time for questions? Where's he gone? Do we have any time for questions?
You have got 5 minutes, so we can fit one or two.
Okay, sure.
Do we have any questions from the audience? One over here.
So to incentivize the equity market, does that mean you disincentivize the residential real estate market?
Absolutely. There's far too much bloody money going on property. Yeah. Get out of property. And look, I'm glad you asked the question because you're a bit older than me, all right? Where are the young kids going to get their houses? Two here. So I actually think this is what's destroyed the Western world. This is where you have anti-migrants, anti-immigrants, because I'm 60-something, have nice houses, and we're very territorial around them, and we keep investing in bricks and mortar. The younger people, they need accommodation. So I have to say, absolutely. There's a bit like ISIS. I'm incentivized at the moment to put my money into Facebook through my ISA account. I have no stamp duty and tax breaks. So look, an ISA is supposed to incentivize British taxpayers. So I actually think government has to be very focused UK, incentivize people. We've said to the small cap companies, they'll grow into the bigger ones, and people start, and that gets the whole thing going. Absolutely. And being honest with you, you're going to have to break a few eggs to make an omelette. Older people will be pissed off. Don't be messing with our retirement, and don't be building more houses. I drove around the UK last weekend, took a car and drove around a bit in advance, and I can't understand, went up to Cambridge yesterday, you leave London, all these big green patches, and there's no houses. Build the whole freaking way to Cambridge. Fill in those green patches. None of the NIMBYs, build them, because the kids need somewhere to live. And stop this ring fencing. Do like the Chinese do. They just flatten the green patches and build them out, and the houses for everybody.
Have you thought about standing for Parliament?
No. There's no money in that. It's better fun being an entrepreneur. Leave that to Rachel Reeve.
I think we need to leave it there. Thank you very much to our panel. A really interesting session. And let's a round of applause for them, please.
Well done, guys.